Something incredibly weird is happening with your money right now. In the span of just a few days, billions of dollars in wealth completely vanished and then miraculously recreated out of thin air. This chart shows the massive roller coaster we just witnessed. Look at the synchronized, wild intraday swings. Safe haven assets like gold went haywire, while Bitcoin investors got completely whiplashed, watching their portfolios shoot up to the moon, plummet to the center of the earth, and bounce right back before they could even finish their morning coffee. One guy in a suit triggered this entire financial earthquake simply by speaking into a microphone. No global catastrophe, no sudden war, just a few vague sentences uttered into the void of modern finance. That guy was sitting right here, at this big mahogany table in Washington, D.C., inside the Federal Reserve. And when he stepped up to these microphones, he signaled a massive shift in how the government manages the economy. Whether you own gold, Bitcoin, real estate, or just have a few bucks in a checking account, the central bank's new game plan is going to dictate exactly what your money is actually worth. To understand the sheer absurdity of what just happened, look at this mechanism. When the economy is looking sluggish, the Federal Reserve pulls a lever to lower interest rates. This releases a highly addictive liquid into the system called easy money. Suddenly, they're printing more money and making it incredibly cheap to borrow cash. Banks, businesses, and everyday people suddenly find their cups overflowing with cheap credit. And what do they do with all that cheap cash? They spend it. They buy cars, they buy houses, tech stocks, and crypto. The party gets wild. Asset prices go through the roof, and everyone feels like a genius. But if people drink too much of that cheap money punch, things get out of hand. People start breaking the furniture. That broken furniture is inflation. Too much money chasing too few goods, forcing the price of rent, eggs, and gas to shoot straight up. When the host sees the living room getting destroyed, they have to do the most unpopular thing possible: take the punch bowl away. They raise interest rates to make borrowing expensive again, trying to sober everyone up and stop the printing presses. This is exactly what the Federal Reserve has been trying to do recently. They hiked rates faster than almost any other time in history, yanking the ball away so fast they spilled it all over the carpet. The strange reality of Wall Street is that the market doesn't actually react to what the Fed does today. It reacts entirely to what it thinks the Fed is going to do tomorrow, next month, or 6 months from now. It's like playing a game of poker where nobody is looking at their cards. Instead, you're placing bets on what you think the dealer is going to eat for breakfast next Tuesday. It is a system built strictly on forward-looking expectations. Because the government can just print money to fill the punch bowl, sitting on physical cash guarantees a mathematical loss of purchasing power over time. You can buy fewer groceries with a $100 bill today than you could 5 years ago. So people look for assets the government cannot print. Traditionally, that has been gold. It's the ultimate boomer rock. It just sits there in vaults like this, heavy and scarce, providing a physical place to hide wealth. Look at this comparison. Bitcoin serves the exact same purpose, but as a fast, digital asset. Instead of a shiny rock, it's a piece of code, strictly capped at 21 million coins, swinging much harder and trading 24/7. Both gold and Bitcoin thrive on chaos. They are heavily dependent on people losing faith in the traditional system, meaning their prices constantly fluctuate based on exactly when traders predict the money printers will turn back on. All of these expectations and predictions collide on trading floors like this one, packed with people staring at screens and waiting for the slightest signal. A few days ago, a rumor started ripping through the market. The whisper was that inflation had finally been beaten, and the Fed was preparing to bring the cheap money punch bowl back. Instantly, traders lost their minds. Expecting a flood of fresh liquidity, they smashed the buy button on Bitcoin and loaded up on gold, sending prices shooting straight up in a matter of hours. Then, the actual economic report came out, showing that inflation is still sticky. The cost of services and rent remains stubbornly high. And then, the man at the microphone cleared his throat and delivered a painfully boring sentence. He said, "We remain data-dependent and will maintain restrictive policy for as long as appropriate." Wall Street hears something very different. The punch bowl is staying locked in the basement, and the house party isn't starting again anytime soon. This is the core of the expectation engine. Because price action is now a bet on the Federal Reserve's future mood, the market remains in this state of perpetual whiplash, suspended in the gap between what the data says and what the man at the microphone might say next. When interest rates stay high, investors realize they can secure a guaranteed return of 4 or 5% simply by parking their cash in a government bond. In that environment, holding on to a shiny rock or a digital coin that pays zero interest goes from looking like a smart hedge to a liability. Institutional algorithms quickly reverse their trades. They dump gold and Bitcoin, then flee back to the safety of US dollars, creating a chart that looks like a cliff face. That sharp spike up, followed immediately by a crash down, is the whiplash. It represents a multi-trillion-dollar market adjusting its expectations in real time. This volatility is a symptom of a structural trap that the Federal Reserve has walked right into. The market is waking up to the fact that the era of cheap money is ending, leaving traditional investment strategies at risk. The Federal Reserve is facing a choice between two extremes. On one side, they have inflation. Cutting rates too soon would cause the cost of living to surge again, destabilizing the economy and making basic goods unaffordable. On the other side is a recession. Keeping interest rates high for too long risks suffocating commerce, leading to mass layoffs and a banking system that could crack under the strain of its own debt payments. To avoid both, the Fed is attempting a maneuver economists call a soft landing. Executing that means slowing the economy enough to kill off rising prices, without stalling the system entirely. A task as difficult as landing the Hattie jet on a wooden skateboard in a hurricane. While the Fed projects confidence, the internal math suggests that a perfect landing is highly improbable. The Fed cannot keep rates high indefinitely because of the hidden variable of compounding government debt. This chart highlights the breaking point. At high interest rates, the cost to service the national debt eclipses the entire U.S. defense budget. This forces a shift in policy. While the Fed publicly targets 2% inflation, they are developing a secret tolerance for letting the economy run hot at 3% or 4%. This is financial repression. By letting inflation run higher than the interest rates they pay on debt, the government effectively melts the value of what they owe, paying back $1 trillion with currency that is worth only half as much. This serves as a stealth tax, allowing the government to save itself while intentionally eroding the purchasing power of your savings account. Institutional whales dumped their holdings to reposition for the inevitable endgame. They are playing the long-term macro math. These large players know that something structural will eventually break. Whether it's a wobbly bank or a sharp rise in unemployment, high rates will eventually force a crisis. When that break occurs, the Fed will have no choice but to flood the system with newly printed liquidity to prevent a total economic collapse. Once the market confirms the money printer is returning, regardless of what inflation is doing, hard assets like gold and Bitcoin will experience rapid rallies. These short-term crashes act as a mechanism to shake out retail investors before the next phase of institutional accumulation begins. When inflation stays higher than the interest you earn, your savings are being actively devalued. In this environment, the math equation of working hard and storing value in a traditional bank account no longer balances. The current financial architecture is fragile and depends entirely on the guesswork of a few policymakers in Washington trying to predict the future. We've entered a period where asset prices swing based on predictions of the Fed's next intervention. Navigating this requires a mindset shift. Instead of reacting to daily chart movements, you must analyze the foundational mechanics of the system. In a system designed to perpetually devalue its own currency, holding onto cash is a strategy that guarantees a loss of purchasing power over time.